Welcome everybody to Safe Option Strategies and to our presentation of low risk, high reward, every trader's dream. I hope that's your dream. How to safely make money in the stock market without the risk of losing money. As I read that, I know that is a very bold statement, but I'm going to show you exactly how we make that happen. By way of a very quick introduction, my name is Jeffrey Dunyan. I am the owner and founder of Safe Option Strategies. I've been running Safe Option Strategies for about 15 years now. I've been running a very successful online investment education company, and I base that success. When I say I've run a very successful company, I am basing that success solely on the success of the students of this program. The number of people that sign up and join our program is not of major concern to me. What is very important to me is that the people who join our program are very successful in the market. Now, this is a free presentation. I am going to try to teach you some things and to show you some things that are going to benefit you as you trade the markets, as you trade stocks and options. I want you to be profitable. There's no cost associated with listening to this class and viewing this information and learning something from that. I'm going to do something different than what a lot of people do when you go online and you sign up for these webinars. They give you all this great information and then it turns into a big giant sales pitch. I'm going to spare you that agony, that deception. I'm going to spare you that. I'm going to be very upfront and honest with you, which unfortunately is not what a lot of these companies do. My goal is to get you interested enough in what we're doing that you will take a look at our education program and you will consider getting involved in our education program. I'm going to make you a very attractive offer and show you how affordable this trading program can be. But I'm going to do that at the very end of the presentation. And throughout the presentation, I am going to try really hard to teach you some things that will be very beneficial to you. And I think that's a fair way to move forward. I think it's much more fair for you to know. But I will ask you this one thing. I will ask one favor of you. In exchange for this not being a 30 or 40 minute or hour long sales pitch, in exchange for that, just stay tuned into this presentation at the end of it and just hear what our education is made of. Just take that last 5 minutes or so and stay tuned in and listen to how we present this information and how we teach it to people, because I think you'll be really impressed with it. I think you'll be impressed not just with how affordable it is, but with how we deliver it and how easy it is to learn what we're doing and to make money consistently in the market and to make money from day one in the market. Okay, that's enough of an introduction. I've got a lot of information I want to get through. I want to teach you some things. I want to help you become a safer, better trader in the market, more profitable. And there's a lot to cover. And I promise we're going to keep this less than 45 minutes. That's my pledge to you, is that we'll keep this presentation less than 45 minutes. But I've got to hurry to do that. Okay. These are the things we're going to cover: how to trade with little to zero risk and protect your principal through something called collar trading. Some of you are familiar with collar trading, but I promise you don't do collar trading the way we do it. I'm going to show you that. I'm going to talk a little bit generally. I'll try and be as specific as time permits. I'm going to talk a little bit generally about how to adjust to protect your trades, how to set up trades and set them up with an adjustment strategy as your backup, so that no matter what trade you get into, you don't have to take big losses. You don't have to suffer through a reversal in the stock price. Whether you're in a bearish trade, it starts to go bullish, a bullish trade starts to go bearish, a trade you want the stock price to stay kind of flat and it moves out of that range, whatever the case is. That's a huge key to everything we do at Safe Option Strategies. It is one of the most appealing things in the stock market today. One thing that more people are interested in than almost anything else is how to take the money they've saved, take the money they've put aside and they're trading with, and how to turn it into cash flow, how to convert that money into more lifestyle, how to pay bills, how to go on vacations, how to have nicer things. But how do you do that and still keep it protected? That's the biggest challenge. Most people who try to create a cash flow situation, most of them struggle because a small loss, a medium-sized loss on any single position can suddenly change what they're able to create with cash flow and what they're able to produce. And it's tricky, and it can be incredibly frustrating. I know more people who have lost a big amount of their trading portfolio due to high-risk cash flow strategies than anything else. So the reason I bring these 3 bullet points on here and give you this little outline is because I have found that 99% of the people that watch this presentation fit into one of 3 categories. They've built up a portfolio, and their number one goal, more than anything else they're trying to accomplish, they want to protect it. They want to keep from the possibility of losing money on that portfolio. And that is what this is all about. The second category they fit into is they want to grow their money. They want to grow it fairly aggressively. They're willing to take a little bit of risk. They understand that you might have to have a little bit of risk associated with it, but they want to grow and outperform the market, but in the safest manner possible. And they fit into this category. And then there are those individuals who they genuinely need or want to create cash flow, and they're struggling doing it. And that's this. And I'm going to cover all 3 of these things, and I'm even going to show you a little bit how they can tie in with each other. Okay, let's move along because there's a lot to cover in a short period of time. Is there any such thing as a zero risk trade? Well, you hear people all the time say, the market comes with risk and you're responsible for any losses that you incur as a result of trading, and all trading comes with risk. I'm not here to refute that, but what I am here to tell you unequivocally is there is a way you can put your money to work for you with little and sometimes zero risk for periods of time. And there are ways to manage and adjust and move things around and profit nicely without ever exposing your portfolio to any significant amount of risk, or to zero risk in many cases. Let me set the stage just a little bit for this first part of the presentation. There are a lot of people who watch this and they have zero interest at all in owning stock because they just want to play options. They just want to trade options and do credit spreads and debit spreads and straddles and strangles. Okay, that's fine. Your part is coming up, I promise. There are some people who own stock and they don't want to get into options, and options scare them and frighten them, and they just too high risk. And you're the people that I want to kind of focus this first part on, but everyone should listen to this. Everyone should hear this. When options were created back in the early 1970s, that's a lot of years ago, when options were created, the primary reason they were created was to protect people's portfolios and protect their money. They were not meant originally to be a high leverage, high risk instrument. That's what most people have turned them into. And there's some good and some bad that comes with that, but that's what most people have done. The reality is they were meant to help protect your money. The long put option, now if you are an option expert, bear with me for a couple minutes. I'm going to give a really quick lesson on how the long put option works almost identical in every way to an insurance policy. When we over time get valuable things, whether that's a house, whether that's a car, whether that's some artwork or some jewelry, old automobiles or restored automobiles, whatever it is, when we get something of high value, we insure it. And most of the time, we might grumble about the price of the insurance. We might compare insurance policies. We might be more willing to spend money if it's a really good, reputable insurance company, et cetera, et cetera. But we don't really balk at the idea of insuring a valuable item. For most individuals, their home is going to be the most valuable asset they ever own, and we don't even think twice about insuring it. In fact, if we have a mortgage, we don't have a choice but to insure it because the bank is going to make us keep insurance on it. And it makes sense. If we had a home that was worth almost $1,000,000. This one I've got a picture of on here is probably worth a lot more than that. But if we had a home that was worth $1,000,000, we would go out and get 900,000. We'd go out and get a $900,000 insurance policy. That's the replacement value of our home, and we might pay $3, $4, $5, $6,000 a year for that policy. And our hope is that the home appreciates in value and becomes worth more. We're paying the home off and paying it down over time. And we're willing to let go of that money to insure it in case of something catastrophic. A meteor falls out of the sky and lands on our home. A tornado comes through and sweeps it away. Recently, in the last couple of years, the folks in California have dealt with some horrible fires out there. There have been hurricanes in Florida and in the Gulf, and there's been some devastation, and thank heavens for insurance and for people who have their assets protected. And as soon as you have that catastrophic situation, you're incredibly glad that you had it protected. It might be hard to spend that money. When you have to write that check for that insurance policy, you might say, oh, I wish I didn't have to do that. But you're really, really glad that you did it if that catastrophe happens. So my question to you, for those of you that own stock, why aren't you insuring your stock position? Do you know, for most Americans, the second most valuable asset they're ever going to have in their lifetime is their retirement account? Whether that's a company pension, whether that's a self-funded IRA or some other stock vehicle, company stock purchase program, company stock options, whatever the case is. Do you know, for most individuals, that's the second most valuable asset they'll have? For some people, it ends up being the biggest asset they'll ever have. And do you know, most people that have money in the stock market don't even consider the fact that they can insure it? With a long put option, you are essentially buying an insurance policy for your stock. Let's say you bought a stock at $100 a share, and you bought a long put option at the $100 strike price. This is like your home. This is like the insurance policy that's valued for the price of your home, and this would represent the premium, the amount you're paying for that policy. When you have that policy in place, if the stock were to drop, the long put option would go up in value approximately the same amount. So we would lose $50 on the stock. We'd be out our premium that we paid for the option, but we'd be profitable $50 on the long put. This is protecting this. That's how a long put option works, exactly like an insurance policy. Think instead of a homeowner's policy for a minute, think about a car policy. You pay your premiums, you pay them monthly, or you pay them every quarterly or 6 months or a year. And when the insurance policy expires, you have to pay it again and renew it. Most people do that monthly. They save a little bit of money on a per month average if they do it annually or do it every 6 months. And you do that in case somebody bangs into your car, or a tree branch falls on your car, or something like that. This is the car. This is the insurance policy that will fix the car. This is the premium you're paying. It works exactly the same in the stock market. You buy your stock, you buy your long put option as your insurance policy, you pay your premium, and you renew it every time it expires. Simple. Now, everyone that I've ever talked to knows something about the concept of cost averaging. You buy a stock at $50 a share, the stock goes down, you buy another share at $25 a share, the stock goes down a little bit farther, you buy another share at $20 a share, and you've got several shares of stock now that the average cost per share is lower on. Okay, the great thing about that is you buy that original stock, you buy the next shares here, you buy the next shares here, you buy the next shares here, and when you've got 3, 4, 5 times the number of shares, your average cost ends up somewhere in between here and here, And you don't need to rely on that stock going clear back up to where you first bought. You could get out of the whole thing with some profit right here or right here. That's the good thing about cost averaging. The bad thing is, let's say you were doing this with 100 shares to start with. If you want to add more shares at 80, you got to come up with another, what, $8,000, $80,000 to add another 100 shares, and another $60,000 to add another 100 shares down here, and another 50,000. Well, my handwriting is horrible. Another $50,000 to add shares right here. You got to come up with a whole bunch of extra cash to add those additional shares. If you start dollar cost averaging with long put options, what happens is you are adding shares at a lower price, but the long put profits are paying for those shares. When you add shares, you're not having to increase your investment. Let me give us, before I even go into these numbers, let me give another an overly simplified analogy. You buy one share for $100. The stock drops to 50 and you buy the second share for $50. Your total money out of pocket is $150, and you're going to divide that by the 2 shares of stock you have, so your average price per share is $75. That's the simplest way to explain dollar cost averaging. What's different when you insert the insurance policy, when you insert the long puts, is that you sell the long put first, then you buy the stock. It looks like this: $100 to buy the first share of stock, a $50 credit to cash in your insurance policy, plus $50 out to pay for the next share of stock. You're still only invested $100. Divided by those 2 shares, your average price per share is $50. And then if you factor in what it cost you to buy those long puts, what you end up with is the same doubling of your share ownership, but with an average cost per share, including the cost of insurance, that's so low that the stock only needs to recover 0.5%, 1%, and you're into a profitable position. One of the things that allows you to have low to zero risk trades set up and still profit from them greatly is this ability to put a collar trade on a stock and then profit by increasing your share ownership and growing it without an additional investment. A collar trade, most simply put, is owning the stock or buying the stock, having a long put option used exactly like an insurance policy, and then using a short call option to help pay for some or all of the long put. If you think more of the car insurance policy than the home insurance policy, it's like when you had your very first car and you had to have insurance on it, but you worked the summer job, you bought the car, and mom and dad said, until you graduate, we'll cover the insurance. It's easier to just have you on our insurance. Think of the short call like mom and dad are putting you on their insurance. Someone else is going to pay for it. Collar trades can be set up for little to no risk. At the open of today's market, Micron, this is an example of how we set up collar trades for our students. Micron was trading at $43.16. We could buy a long put option at approximately the value of our asset for $2.52. That's our insurance policy. We could sell a short call at a higher strike price for $2.59. Our average cost when we add the stock, the long put, and the credit we get for the short call is $43.09 per share. The risk from now until our insurance policy expires is only 9 cents. Not quite a zero risk scenario, but you will find oftentimes similar setups to this that are actually zero risk. If we had bought the 44 strike option instead of the 43, and we made this a 305, that would add, let me see if I can add in my head really quickly, that would add 53 cents. So our average cost per share would be $43.62. I hope I got my math right on that. and we'd have the right to sell at $44 a share, and that would actually be a zero risk trade. Okay, if we were to get called out, I forgot to change these from the last time I did one of these presentations, but if we were to get called out at $48 a share, because that could happen on a short call, 48 minus our 4309 would be a $4.91 per share profit, $4.91 profit, and if you divide that by the 4309, that would be an 11% return for a trade that has close to zero risk. This is how we teach our students to set up and run collar trades. And then I'm going to show you now how we adjust it. What I want to show you right now is when we help our students, when we teach them how to collar trade, and when we help them set up collar trades, we allow them to follow every single collar trade we do to the letter if they want to. Here's the thing. I'm going to talk about this more at the end of the presentation, but here's something really important I want to share with you right now. A lot of people are worried when they get involved in some type of investment education that it's going to take them so long to learn how to do it that they're not going to be able to make any money for 6 months or 9 months or a year. From the day people start our program, they can start following us on our collar trades. This is a real live trade that we have done with all of our students on Micron that started just a little over a year ago, just a fraction over a year ago. Now, looking at this chart of Micron, where are the two worst places you could have bought Micron stock at? Two worst places you could have bought, right here or right here. We got in March 19th of 2018, right about there. One of the two worst places we could have possibly gotten into Micron, we got in. But we got in with this collar trade that I just showed you, with the stock, the long puts, and the short calls. We sent every one of our students on April 23rd, we sent every one of our students an adjustment alert telling them it's time to sell those long puts, buy 100 shares, and then we rolled our long puts and short calls, and we went from having 400 shares to 500 shares for fractionally more investment. That little tiny bit more that we spent right there was for our new insurance policy. But if you notice, our average price per share started up around 60. Now it was down to 52 and some change. In May 28th, we rolled the long puts again. August 13th, we sold our long puts again. We bought 100 more shares. We rolled our long puts and our short calls. We've now gone from 400 to 600 shares. We've had a small increase in our investment, but our average price per share is way down. I'm showing you this because all this information got sent to our students. Any one of our students that could have invested in Micron at the same time we did. Now, you don't have to have $25,000. I'm showing you one example. We've done this with stocks that trade for less than $10 a share. This one traded for $60 a share when we started out. We've done this with stocks that trade for less than $10 a share. I just wanted to show you this. Don't let this frighten you away from this style of trading. Okay, I gotta hurry. September 13th, sold long puts, bought more shares. We had 700 shares now. November 14th, we had to renew our insurance policy. That's basically all that was. Fast forward to January 7th of this year, we added another 100 shares. Fast forward to January 27th of this year, we rolled our short calls. February, we had to adjust the trade again. We had to renew our insurance policy. As of today, Micron is trading at 43.52. Now, here's what I really want you to look at. From where we first got in, Micron is down $16.62 from where we first got in. 27% drop from where we started. As of right now today, our trade is up over 25%. And if Micron, and there's analysts that are predicting Micron's going to get back up to 50 or 60. If it does, we have more than double. We've doubled the number of shares that we started with. Okay, we have doubled the shares we started with. Our average price per share is not quite, but close to half of what we started with. If we get back up to this 55, 60 range on Micron, we will be 100% profitable. We've barely been in the trade over a year, and we're up 25% on a stock that's down 27%. These are all trades that we have done with our students. Apple, up 88%. AMD, we barely got into this one at the beginning of this calendar year, and we're already up almost what the market averages are up right now. Bank of America, we're up 84%. First Solar, 63%. We barely opened this one a couple months ago, and we're up a little bit already. There's the Micron one that I showed you. Nike, we're up 73%. This Under Armour trade, I got to tell you about this Under Armour trade really quickly. We got Under Armour at the day that I'm recording this presentation is trading at $22.65. We got our first shares of Under Armour at about $54 a share. We are down right now more than 50%, down from where Under Armour started, but our trade is profitable, 85%. Folks, more important than any of the profits that I'm showing you, and the reason I'm showing you these is because every single one of our students was able to follow us on every single one of these trades if they chose to. They might have done a different number of shares than we did. They wouldn't have had to have spent as much money on the trades. And there's a few others that time doesn't permit me to go into every trade. But more important than any of the profits is that none of these trades were ever exposed to any significant risk. Most of the time we were in these positions, we had zero risk, or we had 8 or 9 cents a share maximum at risk. That's the beauty of this whole thing. All right, I'm really going to have to hurry through this. One of my students with less than $5,000, this is key right here. This is very key. I showed you that Micron example, and it started out with about a $25,000 investment, and some people went, ooh, I've got a $15,000 portfolio, or I've got a $10,000 portfolio. I can't do that for $25,000. I had a student join my program. He drives truck. He drives all over the country delivering products and goods to different retail places. That's what he does for a living, is drives truck. He had $5,000 that he could trade with. That was it. That was all he had that he could trade with. He put all of it into shares of JCPenney back in August of 2013. And without going through all of the details, he did exactly everything that I just showed you with Micron. Every time the stock went down, he had it protected. Every time he could leverage into more shares, he did so. And it's honestly this simple, folks. Wash, rinse, repeat. Wash, rinse, repeat. 18 months after he got into JCPenney, he was up 182%. 26 months, a little over 2 years, he was up 290%. Just doing what I've shown you how to do here. When he decided to exit the trade, a little over 3 years, he stayed in that trade. When he decided to exit, he was up close to 500%, 475% profit in a little over 3 years. Okay? I spent more time than I planned on that part of it. It means I'm going to have to go a little bit faster. One of the things we teach at Safe Option Strategies is why it is so critical to learn how to adjust trades. Now, everything I showed you with the collar trade, adding the long puts at the appropriate time, selling them at the right time, adding the right price short call, cashing in long puts and adding stock, rolling long puts when the insurance policy is expiring, rolling short calls when the stock is moving, all of that is adjusting trades. If you don't want to own stock, if you want to trade options only, you can apply the same concept of adjusting trades. And the reason you need to learn how to adjust trades is simply this. When we get into a stock, we do not know what's going to happen tomorrow. When we get into an option-only trade, we do not know what's going to happen tomorrow. We don't know if the stock is going to go up. We don't know if it's going to go down. We don't know if it's going to go sideways. Okay, we just don't know. We always have an expectation. We do our homework, we do our due diligence, we say to ourselves, here's what's more likely to happen, or we listen to someone we trust and say, here's what the analysts are saying is more likely to happen. But the reality is we don't know. And if we set up a trade for one of these directions and we suddenly get the one or one of the two that we were not expecting, we have to have a backup plan. And if all that backup plan is a stop loss, you're going to take loss after loss after loss after loss. It's going to wipe out your winning trades and you're going to be devastated. There are so many people that do option-only trades and find that they consistently win on 3 out of 4 of these trades, but the one that they're losing on is costing them a winning portfolio. It's for a variety of reasons, but this is the biggest one, is that they're setting up trades and creating trades that cannot be adjusted. When a trade adjustment is simply this, it is changing through the rolling of options. Okay, that's what a trade adjustment is. Through the rolling of options, it is changing the direction of the trade to match the direction the stock goes when it goes against us. That's what a trade adjustment is. We roll one or more of our options in a spread trade or a collar trade, or when we add a new option to an existing trade, such that it changes the target break even and changes the direction of the trade to match the new trend of the stock. Without adjustments, this is what people experience over and over and over again. They put money in a trade, they make profit from it, they add those two together so their next trade is a little bit more, they profit, they add it in, they make a little bit more, and all of a sudden one trade moves against. And if you trade options only, okay, this is for those of you that are options only, maybe not having to create cash flow, although it applies, but this is for the option only traders. Trade after trade after trade after trade goes your way, and then one goes against you and it wipes you out. And after 4 good trades, 5 good trades, 6 good trades, 1 or 2 of them have you trading down in your portfolio. With adjustments, when you learn how to adjust, the same 4 trades are going to produce a very different result, because the one that went badly against you, that was set up correctly and adjusted, can turn it all around for you. And instead of being down 30 or 40%, in this case, we're up 52%, and 86% difference, because one trade that could have cost us, instead, we turned into a break even, sometimes a profit, maybe just a really small loss that doesn't wipe out all our profits. I'm not here to tell you we never lose money on a trade. That would be very disingenuous of me. What I'm telling you is that if you learn how to adjust trades, okay, this class, even if I hadn't taken as much time as I did with the collar trade, it does not permit me enough time to go into a lot of details on adjusting trades. I will show you, as I talk about cash flow, I will show you one simple adjustment to a very common trade that a lot of people use. Cash flow, cash flow, cash flow, cash flow. We all want to make money, right? We've got this portfolio, we've built it up. Man, wouldn't it be great if I could turn this $25,000 that I've saved and worked hard for and have in the market? Wouldn't it be great if I could have an extra $1,000, $1,500, $2,500 a month from that portfolio? Do you know I have a son that's in college right now that has a $10,000 portfolio, many years of mowing lawns, many years of doing odd jobs for people, working different summer jobs, and he saved up about $10,000 bucks. I was proud of him that he did. He's got a little bit of an entrepreneurial spirit to him. We trade a $10,000, I say we because I'm helping him a lot with this. We trade a $10,000 portfolio for him, and it is paying all his living expenses for college, all of them. It's not covering 100% of his tuition, but he's a bright kid. He got some scholarships. He's done some things to help cover that. All of his living expenses are being paid for. And he's not living like a typical poor college student. He's doing okay. He's getting ready to graduate, and he's probably going to buy a house before he graduates, assuming he gets a job locked down in the area he wants to be in, or the area he's at right now. But the point I'm making is we have been doing this for a period of time, and we've been doing it with our students. And I want to show you a simple example of what we do. Everyone that gets into cash flow, if you've listened to other presentations, if you've bought other education, if you've been involved in other people's stuff, one of the biggest ways people pitch you to make cash flow is through credit spreads. Credit spreads are very appealing. This example is from a couple years ago. I use this example over and over again. I don't change it and update it to stuff that's brand new and fresh, because these are companies that everyone knows: Boeing, Best Buy, Amazon, and these are great examples of what people try and do for cash flow. A bull put spread is a very common trade for cash flow strategies. You get a nice credit. People pay you money to be in the trade. Okay, fantastic return against your risk. You do these trades monthly, or you do them weekly, or you do them just a couple weeks out, and they can really generate a lot of money. Problem is, when a bull put spread goes against you, now if you're new to option trading, this isn't making a lot of sense. But but we can teach you this, I promise. When a bull put spread goes against you, it is a very difficult trade to adjust. That's the challenge with a bull put spread. Remember, part of what I said before when I was talking about adjusting is setting up the trade correctly. It does you no good whatsoever to know how to adjust a trade if you continually set up trades that cannot be adjusted. If you're getting into trades that have no possibility of an adjustment if it goes against you, what good is knowing the adjustment strategy? Bull put spreads are hard to adjust. One thing that we teach, this is one of many things, but one thing we teach in our cash flow strategies is that if you can get approximately a same return, not exact, but similar return on an in-the-money bull call spread as what you're getting on a bull put spread, you're risking approximately the same amount of money. That's your risk right there. That's your risk right there. Exactly the same. There's your risk right there. There's your risk right there. Very close. There's what you're risking right there. There's what you're risking right there. Very close. If you can get these numbers approximately the same, look, we're using the same strike prices in the same expiration dates, which means we need the exact same trend. The difference is it is incredibly easy with the roll of an option to make an adjustment to a bull call spread. Far easier than making an adjustment to a bull put spread. The numbers work in your favor when this trade goes against you in terms of making an adjustment. They work against you when you try and do this. So many people get into credit spreads and they love credit spreads, and someone's going to pay me to be in this trade, but they don't consider the fact that their risk is about the same. Our cash flow strategies last year netted us an 88% return. Now that 88% return, I got to show. Well, let me back that up. I need to clarify one thing. An 88% return if we had reinvested. Okay, this is a result of reinvesting what we're making. It is very realistic, not a guarantee, but very realistic to make upwards of 60-70% annually. Okay, folks, that is, you're talking about, when you're talking about 60% annual return divided by that's about 5% each month. Have the market averages ever been that high? Have indexes ever been that high? Some individual stocks have been, but most people don't even get close to that. Year to date so far on all of our trades, not just our cash flow trades, but all of our spread trades. And I say all of our trades because we send all of these out to our students. Year to date, we are up 23% right now as of today. It's late in the month of April. I know a lot of you are watching. I got a few people on live with me today, but I know a lot of you are watching the recording on our website. So I'm trying to talk as though I'm talking to you individually. But for those people that are on with me live, we're late in the month of April. So if you're watching this and it's middle of May, I'm due to record a new one again. Okay. But as of right now, the US stock market is up 13% so far this year, and our net return so far is 23%. These are trades that we send out to our students every single week. We send our students collar trades on a regular basis, spread trades on a regular basis, and cash flow trades on a regular basis. We only started doing the cash flow the last couple of years as an advisory service. But look at the way our collar trades, and the reason there are two columns under the collar trades, this is for the people who just got in that year. This is for the people who have been with us a longer period of time. People that just got in at the beginning of this year, people that were in with us longer term, etc. Collar trades really, when you've had several opportunities to see those pullbacks and then add shares and see it grow again, when you've had several opportunities to see that happen, collar trades really start to accelerate in growth. The gentleman that did the JC Penney trade, I know I went through that really fast, but the gentleman that did the JC Penney trade, at 18 months, he was about 180% profitable, but at 9 months, he was just about 10 or 11% profitable. He hadn't lost any money. He was perfectly protected all through that situation, not super profitable 6, 8, 9 months in. But when he had several of those opportunities to leverage into more shares, the growth just took off exponentially. Most important to him was he could not afford to lose any of his money that he had in that trade. All right, I'm close to wrapping up right here. I'm very close to wrapping up. I might go a fraction over 45 minutes, but only a fraction, okay? Now, I completely forgot at the beginning of the program, I was supposed to tell you a number and ask you to keep that number in your mind through the entire program. I completely forgot to do it. The number I was supposed to tell you was 1,500, okay? That's the number I was supposed to tell you, 1,500. I forgot. So you didn't keep it in your mind through the whole program. That's okay. Keep it in your mind right now because it's going to be important in just a minute. Really quickly, you've all heard this before. You've all heard, teach a man to fish, you feed him for a day, feed a man to fish, feed a man to fish, you feed him for a day, teach a man to fish, you feed him for life. Okay, I've got two really good friends, a brother-in-law and just a friend that I've known for over 20 years, maybe longer than that, maybe 23, 24 years. They're both avid fishermen, and I do consider my brother-in-law a very good friend as well. Both avid fishermen. I'll go fishing with these guys once in a while, one or both of them, and they pull out fish, and I don't pull out fish. And we're using the same bait. We're using the same hook. They're helping me set it up. They're doing all this stuff for me. They're trying to teach me. They're saying you got to cast into the water right around this spot because this is where the fish are kind of gather. And then when you feel this tension, you got to pull, and you don't want to pull too hard or you yank the hook away from the fish, but you want to pull hard enough to set it. And I try. I make an effort, and I don't bring in fish like they do. Okay. I've gotten a little bit better over time. If I went out as often as they did, I'd probably get better even faster. But there are things that they understand and things that they know and things that they do that are going to take me more time to learn. They know the difference between the tension on that fishing line that means the fish has that bait completely in their mouth versus the fish is just nibbling around the edges. They know the difference. I'm getting better at it, but I still don't know that difference. They understand the right amount of pull to put on that line when they've got a fish on to keep from losing it. I'm still learning that. The only problem I've ever had with this saying right here is what happens if the man starves while he's learning how to fish? I have confidence that my brother-in-law, that my good friend could teach me how to fish over a period of time. But if we got lost in the wilderness somewhere, and we had no way back to, I know this is a silly extreme example, but it paints the right picture. If we got lost in the wilderness somewhere, and the only thing that was going to sustain us was fishing, that's the only way we could survive was to fish. If they did not feed me for a period of time, I would starve. I would starve to death. They would be fine. If they would keep me fed for a period of time, I would eventually learn how to fish and be able to take care of it myself. But if they didn't do that, I'd be in big trouble. Folks, at Safe Option Strategies, one of the things that we do, our primary goal, our biggest focus is to teach you how to fish. I want to teach you how to be safe, how to never lose money again, and how to make a lot of money in the market. That's what I want to do. That's my goal. But I understand that if I cannot keep you fed while you are learning, you're going to get frustrated. You're going to feel like you spent money you shouldn't have spent. You're going to be frustrated because you want to see returns right now. If you spend money on an investment education, you want to get the returns from it right now, starting today. At Safe Option Strategies, we do both for you. We teach you how to do all of this, but we provide you with trades daily and weekly and monthly. We are giving you information and letting you follow along exactly with the trades we do. And we've got a phenomenal track record. I hope you paid attention on that page that I had up here that showed our results. We, by more than double most years, we outperform the major indexes. We're on pace that we're a little past first quarter. We're on pace to have another blockbuster year of 50, 60% or more at the rate things are going. And I'm not worried about a sudden turn in the market. I'm not worried about a China deal falling apart and the stock market selling off, because I'll make money on some trades and I'll adjust other trades so that I don't lose money on them. If you did your research and did your due diligence and asked some questions and you decided to join our program, I am so confident it's the last purchase you will ever want or need to make in investment education. And I say that because I know a lot of you have purchased other things, and it's hard. The idea of purchasing something else is hard. I am so confident we will help you make back the money of the purchase and profit beyond what you ever thought you could do. But let me be very, very clear. Our system is not a get-rich-quick thing. When you hear about these people that are going to take $1,000 and help you turn it into $10,000 in a year or two, they are lying to you. I know that's very harsh for me to say it that way, but they are flat out lying to you. If anyone in this world knew how to take $1,000 and turn it into $10,000 or $100,000 inside of a couple years, they would be the richest person on planet Earth today, and they would not spend any of their time ever teaching it to other people. Please, please, please. And if you've fallen into something like that, guess what? You're a part of my club because I've fallen into things like that in the past. One of the reasons I started Safe Option Strategies was because I was so fed up with people that were doing that. I didn't like it when it was done to me, and I didn't like it much more when it was done to other people. And I said, you know what? I have learned and have added to a strategy and a way of trading that is consistent in any market condition and that will help you make money no matter what the market is doing. And I love teaching it to people. And it's not a get-rich-quick thing. It is a way to protect your money and grow it consistently. Way better than what mutual funds will do, way better than what a broker will do, way better than the market averages. And I'm so confident in it that I give an unconditional money back guarantee that you will profit from what I teach you. I've never, ever used any criteria to measure the success of my company beyond the success of each individual student. Okay, I told you to keep a number in mind. I was supposed to tell you right at the beginning of the presentation, I forgot. I told you to keep a number in mind, that number 1,500. Any one of our programs, our education is simple. We don't get all, well, number one, we don't try and get you in the door for $50 or $100 or $250 and then try and upsell you. I will not do that to people ever under any circumstances. I'm not pretending our education is cheap, but I am telling you right now, it is more affordable and a better value than anything you will find that is even close to being comparable. And I'm not aware of any education out there that covers as much material as ours does. If you just want to learn the collar trade program, you can do it for as little as $1,500. If you just want to learn the spread trading program, you can do it for as little as $1,500. If you just want to learn the cash flow program, you can do it for as little as $1,500. If you package any 2 or 3 of these together, you get a discount, and every one of them has the ability to purchase it as a lifetime membership. Folks, our pricing stays that simple. It's that simple. Do you know how many programs have you watched like this? How many presentations have you watched like this? And they won't even give you pricing. They won't even tell you what their price is, because if they do, they say, hey, you can learn all of this for $100. And then you find out that for $100, you've got the pie, and for $100, you're getting a slice like that. And then they want a couple $1,000s for the slice that big. And then they want another few $1,000s for the slice that big. And by the time you get the whole pie, you're $10,000 to $15,000 or more. And folks, this is the whole pie right here. And I'm not afraid to show people that right up front. If that sticker shocks you, I wish you nothing but the best of luck. We are not the company for you if that is a major sticker shock. But for those individuals who want a little more incentive or are looking for a little better, I'm a businessman. I love rewarding people who are proactive. I know we've gone a fraction over 45 minutes here, but not by very far, just a couple minutes over. I love rewarding people that are proactive. Just by taking the time to view this presentation, you have been very proactive. If you will make one more proactive step, there is no obligation to buy anything from my company. But if you will email me, and you don't even have to start up an email from scratch, there's a link below this video on our webpage that allows you to just put in your name, a phone number if you want to call, that's up to you, a phone number if you want to call, and it will send an email to us automatically. And if you will take the time to click on that little button below the video on the website that you're on, or if you want to give us a call, please leave us a message. If you don't get someone right away, please leave us a message. We will call you back. If you click the button below the video and you want to call back, enter your phone number. I don't make it mandatory that you put your phone number in there, but here, for taking one additional proactive step, I will offer only to those people that email or call a discount over the prices and those are already low prices. If you've ever researched investment education, you know I'm not exaggerating when I tell you that there are a lot of companies out there that will charge $10,000, $15,000 plus for their entire program. That's for their entire program. Okay, if you will email or call, I will offer you a discount that I think will be pretty impressive to you, and you're not obligated to do anything. You can just look at it and say, hey, this works or this doesn't work, or please ask questions if you have questions about it. Folks, I'm wrapping up. At this point in the presentation, there's a part of me that just wishes that I could be sitting down with you face to face. There's a part of me that wishes that we could be on the phone having a conversation, because I hopefully you hear the sincerity in my voice, but I wish you could see it. I wish you and I could be face to face for just a couple of minutes so that I could look you in the eye and say, look, this works. It works really well. My students are incredibly happy with the results they get from this education. And one of the things they are most happy with is that I work with them one-on-one. I am available for them anytime they need help with something, and I genuinely am interested in their success. That is my end goal, is to help them succeed. And I wish there were a way that you could see it in my face and not just hear it in my voice. I care about the people that trust me and join this program. I really do. I do everything I can do legally to help them be profitable. And I unconditionally guarantee that if they're not happy or satisfied with what they're learning, or if it's not helping them become more profitable, I will give them their money back. No one in the industry does that the way I do. None of my competitors will be as forthcoming to their students. You're a number to them. You're not a number to me. We're not a huge company. We're a little bit selective in who we bring on. If I have a conversation with someone and I don't think this is the right fit for them, doesn't matter if they want to buy it or not, I will very politely, very respectfully say, I don't think we're the right fit for you. I don't think we're going to help you accomplish what you're trying to do. I've said enough. I've gone over my time, and I apologize. I told you I'd keep it to less than 45 minutes. Folks, take a minute and email or call and just hear what we're offering on a discount. And if we don't impress you with the discount and show you a way to do this in a really affordable way, then best of luck to you. And I genuinely mean that. I wish you the best. But give us a chance. I think you'll be incredibly impressed, and I know we can help you make more money and protect what you already have. Thanks for taking time to listen today. Bye-bye.